afternoon. My name is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. And I'm here with another monthly edition of our market update. Mid-July 2022, and I'll start sharing my screen with you here. And we'll go to the first slide, and I've marked it up. Same slide that I've showed you the last few months, but let's talk about some changes over the last 4 weeks. Anatomy of the bear market. So I've crossed out the old trough numbers for this correction, and I've put the new one. So the Dow, instead of being down 18%, is now down 15. S&P 500, instead of being down 24%, is down 20, and the NASDAQ is now down 29. So we're having a bear market rally, and for about the last week and a half, stocks have been rising, and that continues today. No guarantee that that this is the rally that sticks, but it's nice to have some relief of pressure, and we'll talk about why that is. Again, approximate causes for this bear market are Federal Reserve rate hikes to fight high inflation. And that just comes as a result of this COVID hangover. Too much stimulus, created too much money printing, created high level of inflation, and a few other things thrown into the recipe, and voila, you have a huge problem with inflation that we haven't had since the 70s, and the Federal Reserve is keen to tamp that down. Second cause is bad investor sentiment. We can talk ourselves into an economic recession by just being too afraid to spend money, companies too afraid to hire or grow or build. So bad investor sentiment, and I would throw in consumer sentiment, are one of the causes here. The last cause, Russian invasion of Ukraine, I've had to line out the last part of that phrase because, as I'll show you in a moment, most of the commodity price premium that resulted from that geopolitical event has now been reversed, which is good news. Okay, quickly to the economic backdrop, and then we'll hit this in more detail later. But the economy is set to grow, or expected to grow, 2.1% this year. This number has been falling, has been revised lower consistently for the last 5 months or so. And so instead of 3%, we're looking at 2.1, still positive, okay, but lower. And for 2023, economic growth expected by the Federal Reserve down to 1.5%. Okay, so growth is clearly slowing, and there's no way to debate that. Inflation will peak this year at 7.9%, not 7. And so those numbers are rising. You got slower growth and higher inflation, and also consumer spending is expected to grow a little slower this year. Still positive, 2.5%. But who knows? Is that going to be revised down to 1.5% by the end of this year? I believe it will still be positive, but clearly slowing as well. On the positive side, though, unemployment remains really low. We just had an employment situation report for June last Friday, and that was very positive. Still pretty solid hiring activity. Let's take a look at the chart of the S&P 500. And you can see that we're off the bottom, that 24% correction from late June. We're off the bottom here for the last couple of weeks or so. And it's, I think investors are trying to figure out whether this rally has legs or whether it succumbs, and then we can move down to a lower level. It's our view here that it's possible this fails. And depending on the news we get on the trajectory of inflation and Fed rate hikes, and especially earnings season that's just coming up here shortly, we think it's possible that the market falls to a new low, and we would be buyers somewhere in the neighborhood of 3,500 to start. So no guarantee that this sticks, but it's nice for now. I mentioned the path of inflation is one of the most important things that we need to assess as investors. And this chart I showed you last time, the black line is a measure by the New York Fed trying to get at a more holistic view of inflation. Some of the measures of inflation they just leave out too much. And so this one's sort of an all-inclusive. And you can see that since, well, I mean, we're at the peak, right? So June represents a peak for this measure of inflation at 6%. Other measures like CPI or Consumer Price Index up at 9.1%, and that also represents a cyclical high. And so you got to wonder, like, okay, well, where is the peak of inflation? And that brings me to the blue line. The blue line is core personal consumption expenditures deflator, and that is the Federal Reserve's preferred method of calculating inflation, because they feel like they have more influence on that measure than on some of the others. So you can see that did peak. It peaked, I believe, in February and has moved lower. So we'll talk about why. I mean, one measure says that there is no peak, and the other one clearly says that a couple of months ago we did peak with inflation. And again, just as a reminder, the higher inflation goes, the more aggressive the Fed is going to get at interest rate hikes. And higher inflation means higher interest rates for banks, and that means higher lending rates. So corporate lending rates, mortgage rates, auto lending rates, all of that. It is our view that inflation has peaked, and specifically, I'll show you here in this chart. This is the black line is crude oil. The orange line is copper futures, and then the blue line is an agricultural commodities fund that invests in futures. And so what you're looking at is expected prices in the near future, and they are falling. So the premium, the oil price premium that we got when Russia invaded Ukraine, that's gone. And you can see that pretty much across the piece, commodities are falling pretty quickly. So it's our view that at least when it comes to commodities, maybe not services, but we think at least when it comes to commodities, inflation definitely has peaked. And that should bring some relief to markets. I mean, you can see it here. This is the bond market telling you that it is also expecting lower inflation over the next 2 years, well, whatever time period, 2 years, and I've also shown you 10 years. But these lines, the blue and the black lines coming down, just show you that inflation expectations over the next 2 years and 10 are falling, and they're falling back toward levels that that we need to see. Now, this 2 year, the blue line, okay, moving back toward 3%. That's great when you consider where we are right now. 3% is great, but the Fed wants to see inflation down around 2. They're not going to probably get that in the next 2 years. Not going to get down to 2%, but I believe they will get to 3, and that's a lot of wood chop. That's great to see, and we want to see lower inflation because any sign of lower inflation is going to cause the Fed to maybe pivot or pause some of their interest rate hikes. And speaking of Fed rate hikes, this is the futures market. So these are bond traders that are betting on how many interest rate hikes we're going to see. And so through December 2022, we can expect another 1.6 percentage points of rate hikes. That number is lower than it was a month ago when I showed it to you. And you can see that this chart is falling. And there's a debate as to why it's falling. So on one hand, if investors expect inflation to fall, then of course the Fed wouldn't have to raise interest rates as much, as I said. So that could cause this line to fall. The other thing that could cause the line to fall is economic recession, because growth slowing to the point of the economy actually contracting, like a recession, well, that's a great antidote to inflation, because of course prices come down when we're in recession. So, there's a debate as to whether the bond market is telling us, hey, recession is imminent, or whether they're saying, well, inflation's falling and we think the Fed is going to calm a little bit and we'll have a soft landing. I need to say something about not just an economic recession, but something about an earnings recession. And public companies registered here in the U.S. are required to announce their results to investors quarterly, and we are just entering that period. So for second quarter results, we're getting those announcements now. And I want you to notice in this chart, the white line is the S&P 500. It's fallen quite a bit this year, right? In the red dotted rectangle. But the blue line, which is expected profits from these companies, is not falling. So you would expect, right, with slowing economic growth, slowing consumer spending, rising inflation, all the things that these companies have to deal with, you would expect that Wall Street analysts should have been taking down earnings estimates for this year and next, actually. But we're not seeing that. We just haven't seen, and I've heard a lot of excuses. Well, maybe analysts aren't sure because the outlook is pretty cloudy. They're not sure how far to take the earnings estimates down, so they're not doing anything. I don't buy that because I think this issue, this conundrum, has been identified and out among investors for a couple of months now, and yet we're not really seeing at the macro level, like at the index level, we're really not seeing those estimates fall. So this is still a big question in investors' minds. An earnings recession would be a couple of consecutive quarters of negative profits or of contraction of profits, and that's of course bad for investors, because as a stock market investor, your long-term growth or gains are dependent on companies achieving sales and profit growth. So there's a decoupling here. Now, we're just at the cusp really of starting this earnings season, but I wanted to point out some comments from 4 different CEOs, and the first is United Health Group. He said he's seen strong double-digit revenue growth across all of his business lines, and in addition, he said that costs are not as high as they expected, so profits are doing well. Company raised estimates for what they think they can do in the current quarter here, third quarter, and the stock is up, I don't know, 5% today. I point this out to say not everything is negative. A lot of the fear, the anxiety, is based on sort of the macro or 30,000-foot view level. But when you start looking at individual stocks, I think there are opportunities. There are companies that are doing okay. Pepsi noted strong demand despite the fact that they raised prices 12% year over year. That's a lot. That's a lot of price to take, but so far it's working for them. BlackRock is it's a global investment company, and we own this for clients, and we always track what they say about the global economy. And the CEO, Larry Fink, just said that obviously 2022 is off to the worst start in 50 years for stocks and bonds. In other words, stocks and bonds haven't fallen this far, this fast in the first 6 months of the year since 1970. And that's a big deal. What it means is a lot of damage in asset markets means things are a lot cheaper. And so he said that well, he's primarily attributing this to investor anxiety, because investors don't know how this whole thing's going to pan out. Not that he's seeing a lot of damage to the global economy that would lead you to believe that we should have had the first 6 months of the year would be the worst since 1970. It's that we have this anxiety and this fear. And I'm going to come back to that notion in a minute. But I'll move on now to PNC, which is a regional bank. here in the US. And this is a comment by the CEO. He said, "I'm personally confused about all the concern that sits out there on banking reserves and the coming recession and the impacts on profitability of banks." In other words, he senses a lot of fear and anxiety, but he's not seeing that on the ground in his company. He's saying that what he sees in the U.S. banking sector is that they have enough reserves, they're very well capitalized, and the impact on profitability from this bear market and potential recession, while he said it could be painful, it won't be anything close to what we experienced in '08. And he doesn't think it's commensurate with the fear out there. I guess it's time for us to hit the recession checklist, and there's a change that I'm going to make this month. Again, we've had red check marks by the first two bullet points: accelerating and problematic inflation, absolutely a reality, and then a hostile Fed. In other words, the Fed is hostile to investors because they're raising interest rates to fight inflation, and higher interest rates usually means that asset prices like stocks and bonds, real estate, commodities, they go down. So the third bullet point, signs of coming economic recession. I think we're probably at 50-50 here. So I went ahead and added the check mark, and I'm going to get to this in more detail in a minute. But I would say, if you look at the predominance of signs, both market-based signs and then economy-based signs, there's probably 50-50 chance that we go into recession. Now, the last two bullet points remaining the same. These are in the green. Investor exuberance, there is none. And high stock market valuations, I just don't think you can argue that the market is wildly overvalued. I mean, it's possible that there are some speculative corners in the market that could potentially go significantly lower. But I mean, even crypto's been beat down. It's down 60, 70%. So I'm going to keep those green. And what that means is that if we do experience a recession, that it should be fairly shallow. And I'm not alone in thinking that. I think that's pretty much a consensus expectation among economists and investment strategists. And so back to sort of where's the data? Is it predominantly positive? Is it predominantly negative? I told you I think it's about 50-50. Let's take a look at the pros and cons again. Bull case. So the bulls are going to say, look, we just got June retail sales number stronger than expected. And yeah, a good deal of that is due to inflation. People have to spend more because prices are rising, but much more positive than I think economists were anticipating. And that speaks to resilience, and that's a word that you're going to hear going forward from me more and more. Next, jobless claims remain very low. We got an employment situation report last Friday that was also very positive. And yes, hiring activity is slowing a bit, but it's still very healthy. And it is true that we have almost 2 job openings for every 1 job seeker in this country. That will fall, but it just shows you that there's a lot of strength in the job market, a lot of resilience to be had there. So next is commodity prices are falling. I've shown you that. And to the extent that we are, as I believe, at peak inflation, that might mean that we're at peak Fed hostility or hawkishness. Finally, corporate credit remains very strong. And so, the bull concept is that, yes, things are slowing. Yes, we could experience a shallow recession, but if corporations are pretty strong financially, if consumers are doing well and still spending money, it's hard to see a deep recession. The bear market case is this. Look, GDP, we think it just contracted for 2 consecutive quarters, and that's like the most sort of simplistic or commonly cited recipe for a recession is your economy contracts for 2 quarters. And I believe that's a reality. I think it just happened. But I've read some economists, I heard some interviews where they're saying, look, don't rely just on that number. Defining a recession is more art than science sometimes, and typically a recession, as defined by the National Bureau of Economic Research, includes a lot of other stuff as well that just isn't a reality for us at the moment. So I'll just let you decide. Next, hiring pause or layoff announcements. It is true that we are now hearing companies talk about pausing hiring activity. So Facebook, Google, or Alphabet. And then layoff announcements have already started for Tesla and Netflix. We're not talking thousands, we're talking about 100, 200 people here or there. But we need to see the labor market slowing. Whether this will turn into a massive wave of layoffs, I don't think so, but we're not sure. So that's part of the bear case, though. Also, they'll say that real wages are falling anyway, because while wages are rising, maybe at a 5% clip through the economy, with inflation at somewhere between 7 and 9%, obviously people are falling behind, and the wages aren't keeping up. So how long can consumer spending hold up when that's the case? That's a big question. And finally, the bears will point to consumer sentiment, which remains historically incredibly depressed. I mean, like at levels, worse than the worst part of the housing crisis, which I think honestly is a little ridiculous. But nonetheless, the concern is that if sentiment is really bad, people might pull back on spending. The Federal Reserve wants them to pull back on spending. And so just to kind of pull back to the 30,000-foot view, the reason the Fed is raising interest rates, okay, is to slow hiring and slow consumption. And that, they believe, is the best way to address higher inflation. And so they're trying to bring things back to normal. But the transition period is it's turning out to be painful. Okay, this month's reality check is going to be Jamie Dimon. He's the CEO of JP Morgan Chase, probably the most respected bank executive in the country. And he says the consumer right now is in great shape. So even if we go into recession, they're entering that recession with less leverage and in far better shape than they did in 08 or 09. And that, of course, is the housing crash. And I think that speaks to my theme of resilience. This economy seems like it has the resilience to make it through a shallow recession, to make it through this transition period, whether it's just a 2022 event or whether it spills into 2023. I think we have the resilience in the economy so that this would not become a major event like the housing crash was. Remember that in the housing crash, if you'd invested at the top, watched it go down and let it recover, it would have taken you 5 years to get your money back. That was a major recession. And in this one, this could possibly, I think it'll be more like your average, where the market dips about 30% and you're looking at about a 2-year duration. So, with that in mind, we are almost 7 months through, and I know from an investment standpoint, the 6-month outlook here is still really murky to get to the end of the year. Does the market fall 30% and kind of bump along the bottom? Do we fall to 30% and bounce? Do we bounce from here? That's a pretty murky outlook, depending on a lot of factors that haven't been resolved, like the path of inflation and whether or not we have an earnings recession, how the Fed reacts as demand and inflation start falling. But it's impossible to guess whether the market has already bottomed or whether it will bottom in the next week, month, 3 months from now. And we think that's a fool's errand to try to hyper focus on when that bottom will be. Instead, we're thinking that the time to sell is done, and The time to de-risk is past. It's now time to start thinking about buying opportunities, to identify levels at which we're comfortable adding risk in order to participate in the eventual recovery, because it will happen. Despite all the fear out there, I mean, if you look back in history, the economy and the market stock market have rebounded from every negative event. The question is how long it takes. And so at some point, you've got to switch from risk off and start to get constructive to move toward a risk on stance. And that's kind of where we are now. So when you hear from me in August and September, it'll be more on the themes of what happened with earnings seasons and how is the path of inflation, and when can we expect to sort of really see a sustainable rebound. I want to thank you for listening, and I'll let you see the disclosures here for a moment. But it's a pleasure to serve you and to extend this information. We always love it when our clients are right there with us on the same page, understand what we're thinking and what we see. So until next time, I'll say goodbye.